I'm Heather Filkins, and we're here today with Jones Lang LaSalle Hotels' Clay Dickinson, Executive Vice President and leader of the firm's Strategic Advisory and Asset Management for the Latin America division. Clay, talk to me about the perception of risk in Mexican hotels right now. There are a lot of fears that this market may be too volatile to get into, but you say that risk may be overblown.
That's right, Heather. You know, we've recently done some research on the Mexico market, particularly focusing on Mexico City. And we believe that based on that intelligence that there's a potential arbitrage opportunity here for investors that have a tolerance for a slightly elevated amount of risk. And it really stems from the mismatch between what are a series of fundamentally strong value drivers against basically the perceptions we think are somewhat overblown of the perceived violence and the actual violence that exists in Mexico City.
Tell me about those value drivers. What are they?
Well, there's a lot of them, quite frankly. You've got Mexico City itself first, right? It's the nation's capital. It is the federal district. And as a result, it's a strong market. It's got a variety of demand-based sources, and it's improving. We're looking at double-digit RevPAR increases for 2012 and probably into 2013. In addition, you've got a lot of high-quality assets that are held by relatively motivated sellers for a variety of different reasons. In addition, there are very high barriers to entry. Land costs in Mexico City, especially in the coveted sites, are extremely high, and therefore it'll be a while before it becomes economically viable to build any new hotels. And then lastly, quite frankly, it's the illiquidity. It's the dearth of competing investors that creates the opportunity.
What about the transparency in this market? Is this a safe place to put your money?
Mexico is an emerging market, all right, so it's not as transparent as the United States or some of the other, mature markets. But as a rule, its proximity to the United States, the business practices that have been in place for a long time, the availability of debt, the professional investment environment that has been there in the past has created a relatively transparent market, especially when you compare it with other emerging markets and particularly some of the other emerging markets in Latin America.
So bottom line, if you've got a bit of an appetite for risk, this is the place to be this year.
Bottom line is we believe that if you've got a little bit of an appetite for risk, there are some very high quality assets there that you could pick up for probably below replacement costs and basically ride the cycle of value appreciation for a number of years before it becomes economically viable for anyone else to come in and build a competing hotel. There are some institutional investors that are being created now in Mexico that they will be comfortable with the Mexican risk, and when they come in, they will form competition for external buyers and eliminate the arbitrage opportunity. So now's the time to strike, but again, you got to have a little bit of a stomach for risk.
All right, thanks so much, Clay Dickinson.
Thank you.